Ladies and gentlemen, welcome to Capital Flow's live stream. Appreciate everyone joining this morning. James is here as well, and we are going to be covering a lot of the title I put for today's stream is The Impossible Trinity Behind the Melt-Up. And we're going to be covering a lot of the macro mechanics behind the drivers we are seeing price action right now. And I think it's going to be really good because, when macro kind of gets a bad rap sometimes, because when people talk about macro itself or the idea of macro, people just think about it as, oh, well, we're just going to talk about some economic data or bigger picture headlines, which is not really the case. When we think about macro itself, it is all about understanding the mechanics of the system for why nominal and real changes take place. And I will say that for macro itself, for understanding macro, interest rates, FX, and things like that, they're probably still, even in today's world, one of the most misunderstood mechanisms in markets, because so many of the things that take place are, in one sense, not readily accessible to post about or talk about because they're both real and nominal changes taking place in markets. And they're very hard to quantify sometimes if you don't understand the underlying mechanics. And so we're going to be talking about those dynamics today. And James, thanks for joining as well. We also have some things to cover on the Qualcomm side. I wanted to talk about that really fast before we kind of get into things. And the idea behind that is we'll go over price action and what we're seeing in markets as well. But the idea behind this, if everyone isn't, been following, James, what was it? Maybe a month ago now or 3 weeks ago that you pitched the Qualcomm idea to everyone on here and we talked about it and the dynamics as it relates to all the AI flows. Break that down a little bit more and then kind of talk about the progression that's taken place and the models that you're using from capital flows and everything like that.
Yeah. So it all started with I have a neighbor who works at Qualcomm, right? And if you're not out there talking to your neighbors, I don't know what you're doing. You know what I mean? This is life, people. So I'm talking to him and he was running me through Qualcomm and I was like, what's Qualcomm up to these days? Like I thought they were, relevant. And like, I look at the stock cause it's just on my watch list and I'm like, what's going on here? Like, why is every other stock running and Qualcomm's not? You guys make chips. Snapdragon is like this big thing. What's going on? And we kind of determined a lot of it is like the story wasn't there, right? Jensen has a story. He's out there. He's in the mix. There's like the Palantir guy. There's just like charisma and publicity and all this stuff. And Qualcomm is just this like forgotten relic of the past. In San Diego, where I live, it's a very big deal because it employs a ton of people. But he was explaining to me, he's like, yeah, it's just like we are positioned really well. We have a lot of like deep connections in the tech and chip world. And Snapdragon is like an amazing, I guess, product when it comes to especially the hardware build out. So like on-person devices, automobile devices, like when you see dashboards in a lot of the makes and models of cars, that's going to be integrated with AI here moving forward, just like Tesla. And then also like they have a partnership with Meta for like any of the Meta glasses moving forward, which will probably be more of a thing. So very much like the hardware on like physical chip infrastructure, they have a lot of octopus tentacles within that ecosystem. And then also the CEO, this guy, forget his name. That's that's actually funny. You shouldn't forget his name. You know what I mean? That's the problem here. Is like his last name's like Amon or something, Santiago Amon or something or whatever. And he's like this great like Forbes top 100 richest dudes, like just world beater guy who came up through the like CEO ranks or whatever, has been part of a couple of great performances as a CEO or whatever. And, you know, my buddy, he's just like, you know, we don't have the story. We lack the story. And I was like, yeah. So I was looking at the chart and I was seeing all these other things run. And I did like a Claude breakdown, which actually type it. If you guys didn't see, I think I put this in our chat during one of the live streams, but I just posted it there in the comment section. You could go read it. This was made on April 24th, right around the time of that gap. And I created this whole Claude breakdown about how this is like the most mispriced AI chip maker in the S&P 500. I think it was trading at like 150 billion when everything else was going at like $1 trillion, you know, like AMD and Intel and all these other like SMH things. And Qualcomm's chart looked really interesting, like a false breakdown on this long-term kind of monthly type of look. And it started to go upwards. And I'm like, man, if there was a time to take a shot at this, it was then. And I mean, look, part of trading is luck, right? Try to have good execution, try to be confident, but then try to hope for a little bit of luck. And I mean, it's been absolutely straight up ever since. And right now on these, I put in a strike price and whatever, they're up like 700% as of today. So a little bit of luck, a little bit of timing in this whole kind of AI push into the SMH sector and stuff. And here we are. That's kind of the breakdown.
I like it. It's like that scene that people post all over Twitter of, he's not even a good trader. He just got lucky. He's just like,
whatever,
tell
dude.
me the difference. Tell me the
I would
difference.
love to be lucky at the Four Seasons in Maui for the next 10 years. That's for sure.
I think one of the key things that I think is helpful, and what we've talked about every day in our kind of just offline conversations, is this model that you've been using every day, which is, you know, the attribution analysis model, which maps, okay, if Qualcomm is rising, how much of that is due to Qualcomm, the tech sector, the subsector of SMH, or the broad index? How much is each one? And what you can do is quantify how much of that is taking place. And, you know, if you're ever trying to think about how people trade dispersion, or, you know, if someone's, you know, a lot of more sophisticated trades, if someone's saying, oh, let me buy calls on this name and sell puts on the index, or, you know, some stuff like that, right? There's a lot more complex option trades that you can do. The way that you're quantifying that, and the starting point, I don't want to get, you know, too reductionistic, is by mapping these flows right here and using the logic that's inside this indicator. And you can get this indicator itself free. It's all on the website. If you go to capitalflowsresearch.com and you go to the website that is all the educational primers, you can see right here, all this section, this bottom indicator right here, it goes over and has that entire model, and you can go to that model itself. And so I would encourage you, if you haven't already, this is your time and your signal to just go download that indicator. I mean, the amount of stuff that I'm going to share, I am sharing, and I'm going to continue sharing for free, is going to be insane. And then the amount of more models and kind of things for paid subscribers is also going to increase. Also, if you haven't already, I also shared an entire interest rate model right here in this PDF that you can just plug into Claude Code, and it'll just seamlessly build you an entire interest rate dashboard, basically with one click. So if you just download this PDF, upload it to Claude, it'll make that for you.
Also, we should add on the right side of those links exactly which ones it are, like the MFRA.
Okay.
We should put that like you have down there where it says like Alfie's stuff on the side.
You're
like
right.
Like just so that everybody knows and doesn't have to click through them all. So we'll get that done for you guys. For the guy in the comment wondering where you can get the code to plug source, that's what he just mentioned. So that bottom stir model, you can go ahead and click that, and it should help you out.
Yep, it's the PDF. I just updated right now. See, oh no, what? Come on. Let's see.
And by the way, guys, you could share my screen when you're done, but I usually couple it with your YC regime shading.
Yes.
right? So you could start to see how the flows act as we move from regime to regime. It's not always super clear, but sometimes it can help you start to understand like the sectors you're looking at, the assets you're looking at, what can you expect from these things when they're moving in and out of regimes, when they're moving different flows. I just think it's the most beautiful visual, and I really like visuals. So I think this is cool.
Here's one of the great things about not having to be in corporate is we can just edit all this stuff on the fly. So here's
there you go.
All the model noted right here. You can go download that. The code's in there. You can just go rip it off if you want. Go sell it to someone. Go, make it better and do something cooler with it and send it back to me so that I can use it and share it with everyone. I've shared this many times. If you want to, build a bunch of like really sick models and you want me to put them right here, I'll put them right here. So I have no issue with that, as long as they're actually, massive value add and super helpful. So that's what I would encourage you to do. The example that I want to go over here, though, on the Qualcomm idea is that when we see this type of attribution analysis, this is very instructive about how you want to think about flows. Because notice right here, you have the primary driver in purple, the primary attribution, the primary driver of returns is because of changes in Qualcomm, not changes in the sector overall. That's important because could Qualcomm just dip back down and go back down to these levels? Yeah, it's possible. But you would need to say, why did this move take place? And is it likely to reverse? Or inversely, is it likely to go up to 320 because of it? And the way that you would understand that is saying, okay, well, if it's just broad market flows, then sure, it could keep going up, but then it's probably only going to go up this percentage, right? Well, 11% has been the attribution, probably a similar percentage attribution. If you want it to be, significant, where the primary attribution is 45% fundamentals, then you would need to say, well, I need to have a fundamental view of the company. And you want to, this goes back to stacking edges, stack the edge of the stock, the sector, the subsector, and the broad market. Once you stack all of those and connect it to the interest rate regime and the broader macro regime, which is what we're going to cover right now, that's really when you kind of have all these pages in the book and you can size up. And I think that's the entire goal of everything I'm doing, is just saying, how can I map the macro regime and be able to take asymmetric bets within that? And, again, every single day I share this, is that the entire goal is mapping the macro regime so that you stay on the right side of it, and then finding a few large asymmetric bets that function as home run trades. If you can do both of these, it doesn't matter whether it's in markets or in life or whatever it might be, you will be successful over time.
Right. And just to add on to that Qualcomm thing, right? Like, for instance, this is a cool example of a trade like I am currently in, right? Where I need to now think about what is my process for my exit, right? Like, I already made my bet. I wanted to add to it post earnings, but it never came back down. So here I am with my position. I could see the flows. I could see the regime. I understand what's going on in the sector. There's some comparables. What is the VIX at? Are we overheated in the short term? Like, what are the vol levels? How much am I up? Like, what were my original price targets? And I start to layer all that together to try and think to myself, how do I want to potentially be exiting this? And I think having this type of stuff up is really good because, hey, if your goal is to make huge macro bets with asymmetric returns, well, the way to do that is like you need to be holding your trades, right? You need to be getting on sides and holding your trades while also trying to not give back a huge chunk of that on the backside, right? So like having the MFRA, having the YC regime, starting to understand interest rates, feeling sentiment and positioning of whatever you want to do, having price targets and all that. I need to start aligning that to like for me, actually, I'll just pop over here real quick. I'll show you. I had this. Sorry, let me get this VIX off. All right. So I had this channel already marked here. Right. So to me, I had in my head that this is that false breakdown I was talking about right here. You can see my screen, right? I'm not just
Yep,
going
you're
crazy.
good. Yep.
Okay. So like we had this channel going up, and when this was false breaking and I was getting some bottoming signals, while everything else in the SMH sector and comps were like ripping, I was like, all right, well, if we can reclaim this channel, I really like this thesis. I really like this position. We did. I put the position on, and I had this channel marked for a long time, and we hit that today. And I took off. I'm probably exited almost 50% of my position. And I'm super happy with that. Now I have a clear mindset as to how I want to go forward with this, which is like, I'm going to hold this. I think it's $1 trillion company. I think the AI plus blah, 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 whatever. But I'm also somebody who likes to take winners to build confidence, to get some cash on the sideline for the next play, blah, blah, blah. So I'm sticking to my process here, but I'm using the capital flows regime indicator, the flows. Like you can look at that. I mean, look at this. Like this is an super extended fundamental flow, right? Like that could keep going, sure. But like as a trader, I also understand that like I need to kind of stick with my principles. We all move our price targets all the time when things are going well, right? And I've seen how that can end. So
Yeah. Yep.
I'm just saying this is how I'm trying to bring this all together to amplify our macro bets that we take.
Yeah, I think that's good. I think the thing that I would add to that is like, okay, we have this fundamental attribution that's really run pretty significantly. But the other thing on a broader basis is this idea that we have for the sector and saying, okay, well, Qualcomm itself rallied, but what about the sector itself, right? And kind of this entire idea that people keep pitching of like, well, it's a bubble, it's over, this everything is overextended. Here's a chart of the hardware sector, which Qualcomm is in. So tech, in the S&P 500, you have the tech sector. That's broken down into two sections, hardware and software. This is the hardware section. Here is, this basically is going to track with the SMH ETF broadly. And I have two metrics, fundamental metrics that I laid here. In blue is the earnings expectations, which just popped pretty significantly. And then I have the actual earnings, the realized earnings in orange as well. And so when people talk about, oh, well, like this is all getting over its skis, all of this stuff about this is a top, people have no clue, these parabolic rises can't last, whatever it might be, blah, blah, blah. When we look at the fundamental metrics, we actually need to recognize that, okay, maybe we could have a pullback or whatever that might be in the hardware sector, but fundamentals continue to ratchet up. So it's not that we're having this, people are going to say that it's the final exhaustion rally. But the final exhaustion rally, whatever that even means, people even say by their own definition, oh, that's when, price diverges from fundamentals the most. This is the opposite, where fundamentals are actually justifying the parabolic rises. And the entire point is that when you have this rally in the SMH ETF, why is it taking place? It's taking place because people are underexposed and they realize that things are much stronger than they realized. So I think that's a really key underlying sector factor that's really key to take note of. And as a reminder, guys, you can put questions in the chat right here. When we think about the data center bottleneck, it connects to this entire idea that I'm laying out, where people were super underexposed still. Again, another reason why I've been very clear that I have no interest in shorting semis, and there's likely to be position unwind in software, but that equity markets are going to continue to rip. And I think NVIDIA is going to keep hitting highs. And we have all of these factors, especially on the space side, which I haven't really talked about. I'm hoping to bring someone on to talk about it a bit more, but what happens when you actually have all of these compute and things begin to move into space, and we need even more chips and compute for all of that. So I think that's going to be a very important thing. Are we at a place where when are we going to be at a place where we're oversupplied? Well, probably on a fundamental basis, not in the next couple of years. And the entire question would be about, well, how is the market pricing those fundamentals? Because right now what we're seeing is that there's still a shortage in chips. So there's still a significant shortage in chips based on the actual things taking place in the economy. How the market prices that is a distinct thing from that. And we're still not seeing the market over extrapolate it too significantly yet. And so I think that's a really important thing on the sector side. And again, if you guys have questions, go ahead and throw them in here. On the source code for any of these indicators, the source code for the MFRA one, that's in the chart. So if you go to the chart, it'll be in the chart. On the, let me see here. Here's a, exactly. Are you really talking about compute in space? You got to be kidding me right now. Actually, so let me see if I can find the tweet. Because it's
sorry, you'll have to excuse me going back and forth because I just saw an auction happen in futures, and I'm like, I'm kind of getting in the mix here too, live. So
totally,
I'm listening though. Here.
No, you're good. Here is, I'm trying to find. Here it is. NVIDIA data center, we're having the next launch. NVIDIA's ecosystem are advancing AI from Earth to space, across Earth to orbit, for imagery, radio frequency. So you're having a shift with StarCloud, and they're connected with NVIDIA to advance this very idea. So you're like, oh, that's so far in the future. No, it's happening right now in real time. So the fact that people don't appreciate this, the fact that we kind of still get comments like this, is an indication that people don't really recognize how fast things are happening, especially on the entire space side, because all those companies are still private. They're not in the headlines of everything taking place. So that's exactly what you want, is people to underappreciate all of the underlying drivers in the background, especially in private markets that people don't talk about as much, because there's a lot of capital has moved private now because people don't want to share the returns publicly. I think what you're going to have now is you're going to have a lot more IPOs that are much bigger because companies want to stay private for longer because there's so much VC capital. And so I think all of those things are incredibly important to kind of recognize. On the larger macro side, and this connects to what I want to cover today, here we go, is we're going to talk about the idea of the impossible Trinity today. And that idea is going to frame this entire melt up that we are seeing. I've talked about that we have AI retooling the economy. We have credit being issued into that in the private market. And then we also have public liquidity being added as real interest rates are still pretty low and at very accommodative territory. And so if you want the chart deck for this that I'm going over today, everything is laid out at capitalflowsresearch.com. All of the educational primers are laid out there as well. And if you guys have any questions, again, everything is laid out here on the website. So you guys can go there and go through everything as well. Let's go to this. When we talk about this idea of macro liquidity, if someone's talking about macro liquidity, what they need to do is connect that to where we're at with the interest rate regime, FX regime, and how cross-border flows function. So if you are in a spot where you're saying, I've heard all these narratives about liquidity contracting, and now we just had the S&P 500 rip over 17% from the lows. Clearly, liquidity is not contracting. If you've been following all the research that I put out, then you know that very clearly. But we need to say, okay, let's begin to build a knowledge and a foundation around why this is taking place, how to think about these factors. And this comes down to what I call, or not just I call, but what is called the impossible Trinity. And the idea is that there are fundamentally three knobs that you can pull in an economic and financial system. And you can only turn two at a time. The third is going to be the release valve. And so if you understand this three mechanism framework for any country, you will be able to understand cross-border flows, liquidity, and how interest rates and FX are pricing. When we are in a world where globalization is so significant, where global trade is so extreme, right? When you think about the trade balance for the United States and how much it's increased over the last 40 years, it is just so extreme in terms of where we're at. And I'll pull up this chart really fast because this really depicts where we're at on an overall basis for global trade. Because if you understand the global trade situation, you'll understand how cross-border flows function. You can see here in the global trade chart, during the run up to 2008, we had a ton of global trade increase where we had the United States import more than export. During the 2010s, we were having deleveraging and global trade was kind of in this range. And then during COVID, when you had the goods section of the economy explode, you had a ton of global trade move out or move in where everyone imported more than they exported. And then the same thing happened here. Now, we're still seeing a trade deficit right here. So even though we're right here, we've ticked up a bit more, we are still likely to see this move back over and the US import more than it exports. That means that people are running transactions and it connects to this three knob approach. So every country in the world faces these same three concerns. So if you are trying to understand how cross-border flows function, how FX impacts any country, this framework is going to be very important for you to understand as we move into any country. And as we have analysis and trades across anything, or if you are just trying to think about what structurally causes these different things to change. And these three trilemmas are, very simply put, three different variables. Number one is independent monetary policy. That simply means the central bank doing the monetary policy based on what they think is best for the economy or for financial markets, and not based on, well, are we weakening our currency or strengthening our currency or something like that. It's just that they're able to make their own decisions. The other thing is capital mobility. So can capital freely flow in and out of the country? So for example, if a central bank is too loose in their monetary policy, then capital can flow out. If they're, allowing and they're creating, restrictiveness that creates opportunity for investors to come in and buy assets, then that allows capital to flow in. And you have capital mobility, and sometimes that can strengthen the currency. And then you have FX stability, or a fixed or managed rate. So are they manipulating their exchange rate? And what we are seeing in today's world is all of the countries that we see are operating between the US and China, because the US has independent monetary policy, they have open capital markets, and they don't manipulate their exchange rate. And the only reason they haven't collapsed is because we have the dollar as a reserve currency status. So when you have that situation, that's why the United States has such a significant trade deficit where they import more than they export, and spending deficit for the US government where they spend more than they make. China, on the flip side, is different because they have closed capital markets. They don't have capital mobility. And there's some elements that are free floating. At the end of the day, it's a fixed exchange rate for the yuan. And that allows them, when they do that, they are, able to have monetary policy in alignment with whatever the PBOC wants, or the CCP wants. And because they are able to cut interest rates and they have closed capital markets, no one can flee and cause a collapse in the currency. So you have the China economy and impossible Trinity on one end, and the United States on the other. And every single country functions in between that, which is now we're seeing the ECB, the BOE, the BOJ all function and try to manage the trade-offs between the two kind of major players in the market. If you want to kind of get an idea of this, I have a kind of a scorecard right here. And again, this will be available afterward. And you can begin going through each of these and saying, where's monetary independence for the Eurozone and Japan and China, and what all of that means for each country and how it connects to price action. And so you can go through all of these and begin to build a framework. And if you think about where each country falls, this is how you come up with FX views or understand how FX can transmit into cross-border flows. And so this is going to be one of the most important charts to understand. And again, it'll be laid out. You can download all of this later on the website. So when capital is free to move, one shared factor explains 70% of what equities, bonds, and FX are doing everywhere. So simply put, when you have open capital markets, then you know what is driving the correlation between stocks and the currency. So if you take the daily returns of any country, the 10-year bond index, and the currency, you can run a cross-asset regression or attribution analysis. Again, I'll be laying out some more reports on this later and some more models. But if you decompose every day's returns and say, okay, well, how much is from the currency, how much is from FX, and you understand how to weight those, and you have just attribution, what is, if you have open capital markets and people are buying and selling and moving the currency to move equities, right? So if you think about it, if someone in another country, let's say someone in Japan, like you, makes another $100, and they take that $100 and they say, I want to buy the S&P 500. Well, they need to take that money, convert it to dollars, and then buy the S&P 500 in dollars. When they go and they exchange yen for dollars, they move the exchange rate. Now you're saying, oh, $100 isn't going to move the exchange rate. Maybe not that specific element, but on net, when you have millions and millions of people and hundreds of thousands of institutions all moving exchange rates, whether that's from buying and selling assets or from hedging their global trade risk or hedging their currency risk, that on net begins to move the different currencies and create what we call cross-border flows. And this is a very well documented idea. There's a lot of people that have talked about this and modeled this and really broken down how it works. I'll share some resources after, and you can go through all of that. Again, everything will be laid out right here. I'll put it in an article, and you can go through all of that on the report section, and you'll be able to get all of the resources that I'll talk about, models, and every single thing, and the slide deck. So if you're not on the website and going through everything will be laid out there, so you can just kind of begin to say, all right, let me think about these factors for the session today. So when we're thinking about capital mobility, the US obviously is a very open country in terms of its capital markets. That's why, part of the reason why we have a Eurodollar system. It'd be very hard to have a comparable system with China and the yuan. When people talk about, the yuan is the next global reserve currency or something like that, again, those people don't really understand how global trade works. They don't understand how, people aren't even trusting the US, and they're still holding dollars, which is why you have so much money going into gold and silver over the last 3 years. And so the US, the UK, the Eurozone, and Japan, they all have open capital markets, and all these flow between each other. But you have to remember, China is the other largest economy in the world, and all of these countries really fall in between the US and China, because China has a closed capital account. The US has an open capital account, which means that there's a lot of things where the impact of China is not felt or really visualized on the world because their financial markets just kind of chop around. Their currency doesn't really blow up. The release valve for everything that China is doing is their trade balance, which means that they're exporting more than they're importing, and they're hollowing out industrial bases, specifically Germany, also the United States. And that is causing a lot of issues with how cross-border liquidity is functioning, and every country is beginning to recognize this. So when we think about the correlation between all these factors and how much of these cross-border flows are pushing around things, here's just a great example of how you want to think about cross-asset variance and how much of it is explained by one factor. When you have macro points really accelerate, that is when, and you have these correlations concentrate, that's when you have these movements where you have the great financial crisis, the Eurozone debt crisis, the Chinese deval, COVID, hiking shock, SVB, and now we're back at these levels right here. We're pretty low overall. And when, again, these factors, when we talk about these correlations, where you look at what's the global correlation between equities, rates, and the dollar, and how do we map those flows and actually understand why they're happening, not just running a basic correlation analysis, but actually knowing why they're happening. A lot of people, when they talk about macro, they need to quantify these moving parts and systematize them. And that's the entire point of everything that we're sharing every single day in these sessions. And so the idea here is that monetary independence is one of the things that you want to watch relative to the capital account. So an open capital gate and your central bank starts dancing to what global central banks are doing. And so, for example, one of the things that people will talk about is how does the US or how do other central banks merge and follow what Powell is doing? Why would central banks even need to follow what Powell, or now Warsh, is going to do? And the reason for that is because countries are cross-collateralized through this exact mechanism. So when you have a shared factor attribution, you have countries that diverge, or they need to converge in their correlations or their monetary policy. So for example, if the Fed is making large moves up or down, and a country is cross-collateralized with that, they have to make sure that people don't flee from their country as a result of what the Fed is doing. And so that's why, in terms of trade and the capital account and every kind of major factor, that's why you have central banks moving more significantly than a lot of other, they're kind of a derivative of the Fed here. And you can see that their volatility is usually higher when the Fed is doing these kind of mechanisms. And so watching these correlations and the divergence of them begins to frame, again, why cross-border flows take place. So when we think about these cross-border divergences, here's just a chart of 4 and 10-year yield changes. And you can see that when you have these correlations increase or decrease, again, you can see periods like COVID just to kind of get a baseline. We are now in a period where we're not seeing them increase very significantly, which when you have volatility fall and capital move out the risk curve, especially into carry trades, that's a telltale sign that you are having every single person, not only in a country-specific basis with the AI trade, but also with a macro cross-border flow correlation on a basis that they're all getting net long the same different factors. And so this is why, when people talk about these liquidity indices that they build or things like that, and they're only using like the rate of change in central bank reserves or the Fed balance sheet, again, you have to look at how that connects to all of these correlations. And when vol falls, what is that allowed to do? People are able to put up more risk, especially on a macro basis. And that's something that people really don't understand as much because they're only looking at whatever country they're in or whatever stocks they're trying to invest in. When, I think especially in the US, we're also US centric. Obviously, we're the best country in the world. But part of that is that people don't really understand that foreigners are one of the largest buyers and sellers in US markets, not only for US treasuries, but US equities as well. And so when we think about those factors, FX is the residual. FX is a release valve for how the function of monetary policy and open or closed capital markets result in these different changes. So cap 2 of the 3 pipes, and the third one has to carry all the pressure. That's why the dollar yen moves so much. So just think about this for a second. When you have a country constrain 2 parts of the impossible trinity, where they have open capital markets, but then they want to basically devalue their currency, or they want to have a certain monetary policy action or whatever that might be. that is when you have the largest moves in one asset class. So this is why it's hard for people to understand how trade expression works. Do they express it in rates? Do they express it in FX? Do they express it in equities? And typically every single year or cyclical impulse or cycle, it's always going to be different. And people will anchor to the last cycle on how it works, even though typically the impossible trinity, balance payments, and constraints around that always change. And so, for example, Japan, mechanically, the BOJ kept the rate pipe calm. So they did yield curve control. They had the equity pipe in, basically melt up, and it absorbed everything. But the result was FX took the shot. And that's why you had such a large move in the dollar against the yen during this period of time. Let me see if I can go to the chart of it really fast. Yeah, here it is. When you had the dollar yen move up so significantly during this period of time, a lot of that was connected to suppressing short end rates. And so if you understand how that works, then you can understand, okay, the rates, equities, and FX, all of those function as release valves for how the impossible trinity functions. And you can connect the impossible trinity, again, capital, monetary policy, and FX policy, or how those are functioning. Those all connect to the economic data points that we have. And so when we talk about macro in itself is one of the hardest things because it sets the highest standard, the highest barrier to entry, because you have to actually understand rates, equities, and FX just to pull together all these factors for the impossible trinity. And you're saying, okay, well, how does this connect to where we are today? We'll go through that, but we really need to set the foundation for how these mechanisms work in the first place. And so when you have two pipes capped, liquidity finds and the equity multiple. So this is really where we are right now, which happens when you have the melt up channel. So let me just say this simply. Let me say this. Risk in the system, we know this, that risk can never be destroyed. It can only be transferred. Same thing with volatility. It can never be, just suppressed forever. It always has to find a release valve. When you understand that, that is going to be incredibly helpful because you're always going to look for the release valve. However, the problem is that that volatility, that risk can express itself in either nominal terms or real terms. That's why I talk about real interest rates, nominal interest rates, and all those factors so much. And I lay them out on the dashboard that I run. And we can even go through any of the countries and say, where are we at with real interest rates? Which, and again, not real interest rates for the US have come down pretty significantly. And this is not the same pattern that we see in nominal rates, because interest rates or real rates are about the relationship between nominal rates and inflation swaps, which inflation swaps right now have increased pretty significantly. Pull this back up. They've increased and they've come back down. And now the entire question is, well, where are we moving with core CPI? And again, if you're been following all the research I'm doing, how this works right now with real rates and nominal rates and how it connects to headline and core CPI with where we're at with crude and the Fed's pause into this. So when we talk about the Fed pausing, that is one of the impulses that has led to the rally that we are seeing on top of the fact that we have the entire AI side retooling the economy. And people will say, oh, well, that doesn't really make a ton of sense because, the AI, everything is just the AI trade. And we say, well, hold up. If everything was just the AI trade, then we wouldn't have the Nikkei making new highs as well. And we wouldn't have a global correlation in also things like the Russell rallying as well, because you have the Russell rallying and the Russell doesn't hold the same semiconductor stocks as the S&P 500 or the SMH ETF. So this tells you that the move that we are seeing is beyond just the AI trade itself, which, again, when people go back to this idea that, oh, we're in a bubble and they just reference AI, they're missing one of the most crucial parts of the entire market, which is that there is a massive driver taking place right now that it's connected to AI, but it's totally distinct from AI on this larger side with cross-border flows capital, credit in the market. And again, global capital markets all moving in lockstep with the Nikkei, with Euro stocks rallying from their lows, with all of these different names, right, still rallying and staying above these levels. All of that is an indication, especially with the dollar right now. I mean, in my view, the dollar is very likely to move down. I've laid this out on so many streams now, and if we have any type of move down in crude, which I think is going to happen sometime in the next couple months, you're going to have some massive down day that people don't expect. That'll take more geopolitical risk out of the markets, cause volatility to compress even more, and allow more capital to move out the risk curve, which is likely to put gold and silver higher, which, again, I've been laying that out for a while as well. If you go to any of the tweets that I've been talking about, I shared this. I've shared all this on the Substack for paid subscribers and everything as well. But when right here. So for what I laid out this morning, I laid this out on May 5th. We're now May 11th. My entire view has been that gold and silver are likely to move up and move off these lows. And even before that happened, if you go back into the research that I was publishing, the entire view that I had, especially on gold, when we were at these lows, is that we were at an extreme right here, and that this was likely a low, and that I was bullish. And then we rallied off that, and then we moved out of FOMC right here, and now we're bidding again. And I think that as the dollar, silver's leading the way, as the dollar moves down, that's going to push the entire metal complex up.
So it seems like the befuddled sense out there is, again, it comes back to this like nominal versus real, because like the way you're setting this up is that like you have the Trinity here, and you have like Warsh coming in effectively. I'm this isn't so blunt, but like if they're capping interest rates from rising and they're capping the dollar from rising too much, you have the outlet will be the equity market. And as most people are focused on nominal interest rates going up, so they think, well, that means that the equity market can't go that high. But in reality, if real rates are decreasing and the equity market is the outlet valve, that's almost ironically what is propelling it even further.
That's exactly right. Yeah. I would say,
and that's why it's so funny. Sorry, it's just like so funny, because the thing you actually think is the brake is the accelerant until it gets too out of hand, I suppose.
Yeah, exactly.
Yeah.
That's the entire thing, is every single impulse in markets is unique, and you need to figure out why it's taking place and how it sets the stage for the next impulse. And it is there. The correlations always change. It's part of the system. It's meant to confuse you, right? Like it's meant to be different than every single time in the past. And I think that is one of the key things that I think people are missing right now, is that when you have real rates come down like this, and also there is, in my view, a very clear, this connects to this larger geopolitical situation, which, remember, people don't like, especially traders, they don't like to talk about politics, because they're like, well, politics doesn't make you money, and, blah, 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 this, and this. But you'll notice that all the guys like Druck or, any of the other large macro traders, they seem to have a little bit better of a pulse on it than everyone else. And the reason why is because if you understand this framework on FX, capital mobility, and monetary policy and how they interact, then political shifts actually become important, because you can actually quantify them instead of kind of just having this broad view about whoever you think is going to be better as a Democrat or Republican president. And I think that the place we're at now is that we have a situation where, because of these lower real rates, and because the dollar is falling, that is setting the stage for an equity market melt-up, which is already taking place. And within that, this is going, I've published reports on this, but the dollar is going to keep falling, in my view, until it begins to drag on the returns of foreigners and they're forced to sell, similar to what happened in the tariff shock. So there's a lot of unhedged dollars in the system right now. Everyone is basically long dollars because they believe that they can always get dollars from the Fed or from global trade or whatever it might be. But if the dollar falls more than, the dollar begins to fall, that can drag on equity markets, similar to what happened in the 2025 tariff dynamic, where this is exactly why it's confusing everyone. Let me put this right here. Is you can see, you had the dollar sell off at the same time as ES, and then you basically had this chop in a range. My view is that we're going to move down, and this is going to push the dollar up until we hit the point where the returns on the dollar are dragging on foreigners' returns more than equity markets. So basically like this is, let's say you take your money and you're saying, I want to buy the Japanese stock market. You take those dollars that you've made from I don't know what you're doing, from your calls that you bought, from the calls. And you say, I'm going to take $1,000 and convert it to the yen, and then I'm going to buy the Nikkei. Because if you want to buy the Japanese stock market, you have to buy it in their local currency. That's how every country in the world works, right? So you go and you say, okay, well, I just bought the Nikkei and it's in yen. And then what happens is, let's say the Nikkei rallies 1% and the yen, this is not the perfect calculation, and the yen goes down 1%. Well, you basically made no money because the currency, quote unquote, inflated by moving, it took away the return that you had in the Nikkei. And so that's why people will say, oh, okay, well, let me get long the Nikkei, but let me hedge my dollar risk. Let me hedge my yen risk so that if the currency goes down, I won't lose money. But if the equity market goes up, I'll make money. The problem is, in the entire system right now, everyone has gotten long the S&P 500, but they haven't really hedged their dollar risk. And so if the dollar begins to fall faster and cause trade to rebalance, and it actually causes a situation in markets where people say, I need to sell my equities to get more dollars so that I can, be able to shift any of these shifts that I have in trade, kind of similar to the tariff idea, that can cause a massive unwind in markets that people aren't really expecting. And it's never really happened before. And this connects to this larger idea about, when is the credit cycle melt up over? When does it end? And this is, in my view, one of the main mechanisms for that. It is either that or it's long-term interest rates blowing out and delinquencies beginning to rise in the economy. And we would probably have to get even more over extrapolated, because the primary place we've had debt grow the most is in the AI sector, right? And all the credit issuance in AI. And so the idea is that we would need to see defaults there as long end rates blow out, which is, we don't really have a situation for that because all of that debt isn't even close to rolling over because we just issued it. And we're still saying all of this, we're still seeing all of the cash flow still and demand for the compute and CapEx build out still continue. So that is, and this is actually a great question here. Maybe a dumb, not a dumb question, actually a great question. What's stopping foreigners from simply hedging their FX risk, their USD risk? And there's two things here. Number one, I would encourage people to go read Brad Setzer on this. He has a great article. I actually wrote an entire report on this exact idea earlier. I think it was end of last year. And let me pull it up really fast, because I think it was probably one of the most important reports that I wrote. And it's still the playbook I'm just kind of keeping on the back burner, because as soon as all of the models that I see signal a trigger, then I'm going to be basically short the dollar, short equities, and changing my entire positioning, which we're not seeing yet. but when it shifts, I'm going to shift. Let me find the report and that explains all of it.
While you're looking for it, I just, this is all starting to come together a little bit better for me
Yep.
with this Trinity stuff, because I like to think like what does everybody think is the most positive thing for markets, right? And generally
Right.
speaking, they think weaker dollar, lower rates, right? That's like the overall, normie narrative. And ironically, as we push up in rates and the dollar's constricted, or sorry, like as we push up in interest rates, that goes against the common narrative, right? And then I guess I'm kind of thinking down the road, you would have this moment of, I think you're kind of almost seeing it as like a capitulation moment in the dollar, where the dollar gets extremely weak and it almost throws yields even further up. And that would maybe be more of the signaling point of the real problem to come. But until that occurs, it's basically going to be climbing this narrative wall of worry where dollar sideways to down and rates sideways to up would be the thing that causes a continuous melt up. Am I kind of like thinking about that in the right way?
Yeah, I think it's twofold. If this actually goes back to,
or I guess, sorry, ironically, to finish that point,
Yep.
as yields would actually roll over, would actually like where yields start to go down, would ironically be the point where risk would start to turn off.
You mean selling in equities?
Selling in equities.
Yes.
And ironically, that would be probably coinciding with more of a bottom in real rates.
Correct. Yeah.
Right.
So,
and then it would basically be flip of what's happening now.
Exactly. Yes. So to kind of pull that together for people, the idea is that, okay, so twofold. One, on this question, go through all these reports on the Substack. November 26th through December 2nd. Read all of those, go through every single thing in there. Even if you're like, oh, well, I don't think this matters. It matters. You need to understand it. Go through every single report on that section. To connect that to what James is saying, this entire idea about real interest rates and nominal rates and how it connects to these, factors here. Notice that, 2-year real interest rates, notice that during COVID, they actually spiked. They didn't fall. And why is that? It's because the Fed wasn't cutting fast enough. During 2008, real rates were the thing that were rising really significantly. And that's important because that is what caused a contraction of liquidity in the system. Now, that overlapped with a stronger dollar, but it's very possible for the opposite to occur this time, depending on how this impossible Trinity thing kind of plays out. So here's what I'll say. Understanding interest rates for nominal, real, and inflation swaps and how that connects to the currency is the math, is the quantification framework to connect to the impossible Trinity. And there are a lot of different scenarios. Again, people aren't going to like to hear this, but there's a lot of different ways that this can play out because there's a lot of complexity in the factors. But the entire idea is that when you see these correlations shift, that will send you a signal about the regime that we're in. Right now, the melt-up channel that we are in is that when you have this idea of, global liquidity is still at a surplus and you have the FX side of things not really blowing out and bonds aren't blowing out and liquidity is expanding, that allows equity multiples to rise, which is why we're in the melt up that we're in right now. And there's a lot of different mechanisms for that. Part of that is vol just compressing, right? Like, for example, if volatility falls, that means the market views the distribution of future probabilities as more narrow. So it basically believes that less crazy things can happen in the future. And when people believe that less crazy things can happen in the future, then they basically put up more risk because less crazy things could happen in the future, right? If there's an earthquake and everything starts to kind of fall apart, it doesn't matter if that creates a probability of a higher probability of an earthquake in the future or not. People are just going to say, I need to play it safe for the next couple of months or weeks. And so that's the same idea of volatility that we're in. And it connects to the United States being the center with the global reserve currency status of the impossible trinity. And again, I would go to Brad Setzer. I would go through some of these papers I have referenced here. You can go through all of these, and they'll be available afterward in the slide deck on the website. So again, if you're not, just wherever you're watching this, in the comment section below and the link above. I mean, if you can't find a link these days, I don't know what to do, but everything is there. The US sits at the center of every other country's impossible trinity. So this is a really key idea for where we are right now with how unique we are. We are at the highest global trade that we've ever been in history. And we are at the highest equity valuations we've ever been in global history. And then while we're at those levels, we are having the greatest retooling of every single element of the economy in history. And the US dollar and the US itself sits at the center of every other country's impossible trinity. So simply put, every other country, their impossible trinity is directly cross-collateralized with the US. So the dollars as a reserve currency of the world, the Fed's reaction function is a global cost of capital benchmark. Treasuries are the safe asset that every other country's capital flight runs toward. The US trinity is therefore unique. Capital is fully open, FX floats, monetary policy is fully sovereign, but that sovereignty comes from being the asset everyone else flees to first. So privilege creates dependency on the rest of the world to recycle dollars back into treasuries, or right now, in this case, into US equities, because people realize that there's inflation risk in the system. And so this is one of the reasons why we have the melt up that we are seeing right now. And if you want to kind of dig into that, go through these papers right here, because I linked some papers that will be helpful for you to go through. Well, the dollar's erosion, understanding the loss of reserve currency status, how does that work exactly? Exchange rates, natural rates, and the price of risk, the high frequency effects of dollar swap lines. All of these factors connect to where we are. And again, people are going to use this catch-all term of dollar devaluation, dollar devaluation, dollar devaluation. Saying dollar devaluation, yes, that exists, but that's like saying stocks go up over time. It's a true statement that doesn't provide any value to you as a person. The way that you want to understand this is saying, how does changes in purchasing power connect to this idea of the impossible trinity, and then thereby to interest rates and every risk asset in the system?
So I have a question for you just on that previous slide of the situation for other countries. So in the recent past, we have had where we were tightening and pausing and tightening fairly aggressively. And then I think it was like in the EU, they were starting like a cutting cycle earlier than us. Am I remembering that somewhat correctly?
Yes, Europe started a cutting cycle before. They cut more than the United States, and now they're hiking a bit, or they have more hikes priced on the curve than the United States. So they overshot, and now they're having to recalibrate and overcorrect.
Okay, so that leads me into this again, moving forward. If there's a point where the US is going down, or the US currency is going down, and we are starting to work rates back down, but inflation is sticky, especially broadly, and they then have to keep interest rates tighter and higher than we are. is that more incentive for people to sell out of US assets because yields here are going down, yields globally are remaining higher, and the dollar is weakening. And if they want to repatriate money back across, they're selling more dollars and putting it back into those currencies.
Okay, so part of that is correct in my view. The other part, I would kind of just refine it a little bit. So what I would say is that on the European side, yes, they are being more restrictive than the United States, which is why the euro is rallying. And that's why we are seeing euro stocks and the DAX underperform the S&P 500. So for example, once this will be a great trade if you guys want to trade euro stocks and the DAX. But notice right now, ES is at, well, let's just use the Russell actually, so that, we kind of take out that whole AI effect. The Russell.
Switch to your chart.
Thank you. The Russell is at these levels right here. And when we look at the Russell relative to the DAX hasn't made an all-time high yet. And here, let me put this on a different axis. The DAX hasn't made an all-time high yet. Neither has Euro stocks right here. Why is that? Part of that is because the ECB is being more restrictive. So notice right here, the forward curve in the Eurozone is basically pricing a lot of hikes across the curve. Let me go to the strip. So you notice right here, right now we're at a rate about 2.83%. The market is pricing higher and higher rates across the entire Euribor curve right now. And that basically means they're being more restrictive. And, as a result, for example, let's see if I can pull this up. See, I'd have to build the chart, but basically real rate differentials are basically driving one of the major dynamics where Europe, because they're more short energy, they are having to hike more. And you can see in their Z6 contract, it's still pretty aggressive in the rate that it's pricing, whereas the US side is a little less aggressive. And so the ECB is being more restrictive. That is causing their market to underperform a little bit, which is pushing more capital into euros. And people are basically moving into euros more because of the differential on the rate side. Once that begins to shift and the ECB begins to flip, then I would expect a catch-up trade where euro stocks begin to rally more and they outperform the US stocks again. And that will probably overlap with, once crude moves down, you'll see once crude moves down, you'll probably see this little blip in the dollar where positioning unwinds a little bit, where you'll have the euro I think we'll probably move up a little bit. And then once you have euro stocks up, crude drop, you'll probably have it like move down just a little bit and then move back up. It could be even smaller than that. It could just be right there. But that's kind of the idea for how I think about that, is you're going to have this, once the ECB flips, when crude begins to fall, you'll have this catch-up trade where those stocks will begin to outperform. But we're still not in a spot where we're going to say, oh, well, people are going to sell US assets to get into euro stocks. Mm-hmm. It's more driven by the rate differentials right now than it is on the equity differential side, because people still don't want to sell US equities because they're still sitting on a lot of gains. And that's where kind of a lot of the growth, and there's a lot more growth in the United States right now than the Eurozone. Shocker, right? So that's kind of how I would frame the situation, if that makes sense.
Yeah. And I don't necessarily mean having it go into like European stocks, but it could be into their bond complex, right?
Exactly. So that's the exact idea. I think that it would be going into their bond complex as opposed to stocks, but that probably it would probably not be so significant. It would more be about European investors readjusting across the risk curve, and that might cause markets to move around a little, but it's not going to be that significant. Because Eurozone is only one player in kind of the global market, right?
Yeah.
They're a very large player, obviously, but we also have the Japan side and a lot of these other factors taking place as well.
Yeah, just generally using them as an example for this. But yes,
totally,
right,
right?
cool.
Yeah,
Thanks.
because that same mechanism takes place across every country, right? Because we have the Fed at the center, and then you have the UK, you have the Bank of Japan, the PBOC, but you have capital controls. So the main thing you want to watch for the PBOC and that entire side of thing is global trade, and then European Central Bank as well. And so, the reason why that they want to track the Fed sometimes or diverge from the Fed is because of how much trade is connected to that. And so I think that'll be one of the really key things that we watch. This entire situation, especially with the dollar and how it's connected with the Fed, the central bank, you'll notice that people can just run the rate of change of the balance sheet, but at the end of the day, the Fed balance sheet has fallen so much, and you just had equities rip the entire time. So you literally have liquidity contracting. The Fed balance sheet is causing a contraction in liquidity in the system, but equities continue to rip, which just kind of, again, goes back to the entire idea of there are more drivers in macro liquidity than people would like to admit. And they're very hard to understand. You can't just kind of pull together a couple data points. I'm writing a report on this right now where I'll provide a lot behind it, but you want to really shift from always hopping to different data points every single cycle and begin to ask, what are the different drivers that are continuing to provide impulses to the market on the upside or downside? How do I map those and connect them to those data points instead of just always kind of chasing like, oh, well, first is the TGA, then it's the reverse repo, and then, there's all the bull and bear posting on either side, and, clarity is lost in the middle, right?
Mm-hmm.
So that will be one of the things that I lay out again after I'll lay it out in the report. I'm writing it right now. On the China side, if you want to go through and understand how China's, monetary independence plus FX stability, but they have a capital controls, read all of these papers. It's probably one of the most non-appreciated things, because the thing is, in the United States, a lot of people, all the liberal people are typically paid by China, or there's a lot more payments from China in that kind of realm. And then on the conservative side, a lot more people are free market. And so they'll just say like, oh, we'll let China do whatever they want to do. And that's why Trump taking such a hard stance on China is kind of hated by everyone, because they're like, oh, we'll let free markets be free markets. And then other people are like, why are we pushing back against China? And at the end of the day, the combination of Trump, Bessent, Warsh, and Myron at the Fed are taking an active stance against China, because China has been conducting economic warfare against the United States by suppressing their currency. And people think like, oh, suppressing their currency, that doesn't sound very bad. What's the problem with that? Like, no one's getting hurt by that. And people just don't get that. This goes back to like people when, like, if you ask anyone, like, what's been happening to like the economy, they talk about inflation, but they never talk about their incomes being negative in real terms. So when you ask someone like, what do you think about inflation? They never say like, wow, my income is negative 3% in real terms. They always say prices are higher and it's hard to buy things. They never say, oh, real purchasing power is changing, because all of us look at what is physically taking place in the nominal world. But when you begin to understand the real purchasing power changes, then you'll begin to say, oh, yeah, China suppressing their currency is a real purchasing power change. And anyone who actually imports and exports things from China totally gets how this works, because they're like, oh, tariffs, or oh, China, or an exchange rate moving. Wow, I need to now pay more money, and that costs more money, or it costs less money. And now you begin to have, businesses get, pretty significantly impacted by global trade. And so, again, breakdown of China's capital controls. They are, they have, in terms of GDP, China has a lot more spending on investments than they do household consumption. And so what happens is you have a lot of more, infrastructure loans. You have a lot more, basically people trying to get out of China through crypto and gold and things like that, which is why it's been banned in China. And the surplus of dollar liquidity has been one of the things that has caused global equity markets and interest rates to correlate together. I think it's one of the main factors. So I have a chart here of the offshore yuan. You can see kind of a breakdown of this. Even though we have been falling a bit, which is, Trump and the administration trying to get the dollar lower versus the yuan, we are still massively overvalued in the yuan, which is something that is an unseen effect for how trade and capital reverberates across the system. If you want to understand Japan as it connects to China and the US, think about China as the, they're the guy that is always selling you stuff. And then Japan is always the one who lends you money so you can buy that stuff. And so Japan is kind of the global carry engine that everyone uses. And again, if you want to understand the carry trade, there's an entire list of papers right here. They'll be available afterward. You can go through and just go through all of them. What I would do is just take this entire slide deck, feed it into Claude, ask it to just educate you on how these factors work from these papers. And the idea is that Japan runs the world's longest experiment in clamping, basically doing yield curve control while they have fully open capital markets. So FX took the full load. The dollar moved against the yuan from 100 to 160. I mean, just imagine a 60% devaluation in your currency. And you just had such a massive unwind in that trade. And that carry trade is what is reverberating across US assets and every other asset in the world, especially with things like the Aussie yen trade and how people are managing carry. So on one side, if an exchange rate moves, it's harder to import versus export. So for example, if I run a clothing business here in the United States and I continue to buy my stuff from China, if the exchange rate moves, now my costs are moving up or down. On the flip side, if I want to borrow money, I can borrow that in the yen or I can borrow that in dollars. And so if I borrow that in the yen, then any changes in the exchange rate will make my liability, my debt, harder or easier to repay. And so when we talk about carry trade, it's all about basically borrowing money and the impact of an exchange rate on that. And again, it's something that's very hard to understand for a lot of people, which is why a lot of people just ignore it and they say, oh, the dollar's correlating or the yen's correlating, or maybe the carry trade is going to unwind or something like that. In reality, it's all about, well, how is that carry trade or that debt that they've taken out, what do they use that debt for? So for example, if I borrow money, did I put that in equities? Did I balance that against a dollar liability or a yen liability or a yen, denominated invoice for some type of trade? There's so many different ways that the balance sheet can net out. And you want to begin to map how that's netting out for flows, and then how exactly that connects to kind of the global system overall with correlations between stocks, bonds, and currencies. And the idea right now, so how does this all connect to where we are right now, is that Japan and the carry engine that exists is directly linked. And here's interest rate differentials in blue. We're now having a pretty big divergence take place. And you have the release valve for this, as the currency is flat, is the Nikkei and US equities melting up. Again, the Nikkei has valuations above like the 1980 levels in market cap to GDP. So we have this massive release valve all being pushed into the Nikkei in a pretty new way as government spending in Japan from the Ministry of Finance is increasing as well.
So just to touch on the Japanese situation there, this chart will help explain it. So could you walk us through a little bit of how once inflation expectations kind of unanchored and they basically started running in Japan, you saw this situation where the yen started to really weaken and the Nikkei started to rip to the upside. can you just explain a little bit how the three valves shifted and how we've moved into this is seemingly like what we're maybe envisioning here in the States. And then, so would the same idea of the big maybe capitulation move in the yen with a final rate spike in JGBs or something correlate with maybe the peak in the Nikkei?
Totally. So let me pull this up and let me break this down. So notice, that's right. Where are we? Yes. Okay. Right here, you will notice that during this entire period of time, so basically in the chart, we have the yen against the dollar, so the yen futures in the candles, and then in blue, you have the 10-year yield for Japan. Now notice, during this entire period of time, the BOJ did yield curve control. And they said, if and you can just see this in this, anytime you see interest rates just staying in this range and then the currency is whacking all over the place and inflation is rising, it's yield curve control. And obviously they'll always do that. They'll always say yield curve control is they'll buy an unlimited amount of bonds at a certain level to suppress interest rates. And then this is when they changed their yield curve control target right here. But you can again see when you have these different moves where you have yield curve control in these like straight lines, and then when you like whip down, unwind positioning, rip back up, and we're continually unwinding positioning. This pattern here is purely yield curve control. It's showing that you're having the release valve somewhere else. When that is happening, and especially in this period of time right here, when you have yield curve control, the yen, inflation accelerated, the BOJ suppressed interest rates, and the yen devalued massively. And basically, you had the same thing take place here as well. Now, what has shifted is the BOJ stopped doing yield curve control. They allowed rates to rise, but the entire driver shifted. And because the yen has still moved down, the entire driver shifted because now what you have over the last couple of years, and especially last year, is the Ministry of Finance has now begun spending a ton of money into the economy. And I've shared, if you go through some charts, I'll have to go through what the report was. But let me see if I can find the report name. I remember it's on the Japan and the yen. Let me see if I can find it.
And also, can you just maybe opaquely overlay the Nikkei on this chart? Just so we could see that what happened when they were doing yield curve control and the yen was dying. And
so
for now.
When they were doing yield curve, let's get this. Yeah. There we go. So when we had yield curve control and the yen was falling like it was, the only reason you can actually see the Nikkei fell, but that was more because we had the global hiking cycle from all these other central banks.
That's an orange, right?
Yes. So I'm trying to. My computer's freezing. Yeah. So let me get this.
Yeah, from what I'm seeing on my side here is that it kind of, to your point, the valve that was expressing everything was the yen, and then the rates and the stock market were just kind of sideways.
Yes, and then you will notice that now you have this move down in the yen right here, and this has been because you have a ton of government spending. Am I coming through right now?
Yep.
Okay. You've had a ton of government spending into this, and the government spending has outpaced the higher interest rate. So for example, let me pull this up. We're going all over the place, but this is really good because I think it'll really help people understand these factors a bit more. 1 year real interest rates, and this has caused the yen to tick up a couple times. One-year real interest rates, they ticked up for Japan a little bit, which caused some pullback in the Nikkei. But 1 year interest rates, real interest rates, are still negative. So this is a massive, on a structural basis. This entire time, real interest rates have been negative. They only just went positive a little while ago, and then they turned right back negative. And that's that's because Japan, they're short oil, right? So they are a country that has higher oil prices impact them a lot more than any other country. And so you have their, real rates beginning to fall. And then you have, for example, in their country, inflation swaps begin to rally and Japanese inflation swaps push up. And the BOJ is not really doing a ton. You have, interest rates, nominal rates have pushed up a bit, but a lot of it connects to the short end because so much about Japan is on the short end right now, especially in terms of the carry trade and everything else. So when we connect this back to this chart, this entire move in the yen down, this is why Paul Tudor Jones said, the yen is really undervalued, because this entire move up in the Nikkei has been valuation expansion. So basically, it's more and more premium that you're paying to get long risk assets in this valuation expansion. But then you're also having higher and higher interest rates, which is kind of compressing and creating this massive wedge, which is why in that interview with Paul Tudor Jones, he said, eventually what's going to happen is you're going to have a pretty significant rally in the yen, and then you're having a fall in the Nikkei. And that's going to likely be one of the things that unwinds this entire credit cycle. It's going to be directly connected to it. We are not at that place yet, which is why I've not been getting long the yen. I don't really want to get long the yen yet, because what we need to see is a significant decrease in the liquidity drivers. I still think the yen is going to move down because you have all of the government spending in Japan still running hot. And so that's going to increase. And you'll notice that all these moves here, I'm pretty sure, I know this one especially, has at this level just been intervention in FX. So they're not pinning the exchange rate, because if they're pinning the exchange rate, they'd probably take inflation through their economy and just rip it. But they are intervening in markets in a kind of a smaller way. And that's caused the yen to tick up a little bit, but it keeps kind of just rolling over to the downside. And so this dynamic with the yen and positioning is in itself one of the major factors. And the government spending in Japan is one of the major sources of global liquidity. And it's going to continue in this way until the credit cycle melt up and all this positioning premiums in AI get overdone, and they begin to have secondary effects that are unsustainable. And that, again, goes back to this entire idea of the impossible Trinity and how it connects to Japan itself and the global carry trade. So again, you want to go through all these slides, and I have a section here on each country. So for example, we talked about the entire impossible Trinity from an educational fundamental basis, and then I talk about it from the US, China, and then also Japan. You have all the papers here if you want to go through them yourself. And then also all of the dynamics for the Eurozone. Again, our comments earlier about, well, once crude falls, you're probably going to have a catch-up trade, because remember, the Eurozone is short crude, and the entire Eurozone itself is split up into, Germany, France, Italy, and these other countries that are all kind of playing lead lag to one, European central bank, which at the end of the day, anytime the European Central Bank does anything, it doesn't matter what it is, one of those countries gets cooked. And there's always this trade between, let me get long Germany, short Italy, or whatever it is between the spreads. And a lot of European interest rate traders are always trading all of those spreads. And so, again, that's why in terms of carry and all these other things, a lot of people are, trading this pressure, this macro pressure between each of these countries as well. And then the UK, kind of very similar situation, except they're kind of on their own a little bit more. You can go through all the papers on them, and they're trying to figure out their entire world right now as well, especially with all the political turmoil that you have and all of the stress that you had in the pound, and that you're in a situation where the pound is probably going to rally further just because it's going to fall against the dollar. But overall, their country is facing a lot of issues. And so, again, if you want all these breakdowns and all the resources for it, it'll be laid out on the website. I'll send out a report later today. You can go through everything yourself. I hope that all of these different factors are kind of bringing up really important things for everyone to think about as we move through why these factors are taking place, and beginning to ask deeper questions than just, oh, well, dollar devaluation, stocks go up over time, let's just, keep buying calls, because that will work, but there is going to be a moment in time where that doesn't work. And if you have taken anything away from this entire session, you'll know that the global carry trade, global liquidity, they're all moving in the same direction and compressing right now. And that's why everything is getting more and more one-sided, which is why the melt up is occurring, which is why I've been laying that out for a long time now. And until my strategies indicate a shift, not just in one single factor, which is why I didn't really get bearish earlier this year when crude was spiking and causing equities to sell off. My entire view has been that is likely to set the stage for more of a melt up, and that occurred in lockstep. And we're always going to have 5% pullbacks or something like that in equities. A 5% pullback and everyone thinks it's the end of the world. I'm not even going to acknowledge that. I think it's important to map those and understand what's happening, but to recognize that that's not a structural unwind. Like, look at all these larger pictures, all these larger factors that are taking place. So I think that's just super important. I know we have a lot of questions in the chat. So if you guys have questions, you can put them in there, and we'll go over them as well. And I want to cover some of these. Let's see. Is the dollar trade sell-off a function of real rate differentials, particularly of the net countries? Yes, it has been one of the main things, which is why I talked about that for paid subscribers a little while back, and just said all the countries that are net short crude are going to have higher interest rates, which is why the dollar is going to trade back down. But it's also why their equity sectors are probably going to underperform U.S. And but it's also why that once you have a dip down in crude, you want to be so aggressive. And the market's going to be aggressive at hitting the bid on the Nikkei, Euro stocks, the DAX, Australia. Like, they're going to hit it so hard. People don't even get it. It's going to reverberate across other equity markets because it's going to take a lot of additional risk out of the system. So I think that's really key. Other question here: does your time frame of 2 to 3 years on infrastructure demand in AI factor in the global potential of central banks hiking 1, 2, or 3 times this year? This should certainly drive the dollar down. If I'm understanding this correctly, here's kind of a little bit of the problem with the. I think it's a good question, but here's the thing: is if the European Central Bank hikes interest rates, that's not going to change if Anthropic or Oracle or any of the companies in the United States are going to change demand for them. So I think that this goes back to the video that I did last week, which you guys, have to watch it, or you have to go through it. Let's see, walking the thin line, how AI is compressing the tails. Go through this entire breakdown, how AI is compressing, and the cross asset. I think this is the one where I talked about how we are seeing a compression in everything that's taking place and why it's taking place. Let me see. Because the idea is that the the AI side always is, I'm going to have to link it, but the AI side is creating a different hurdle rate for the amount of money in the system. And so as a result, that changes how these factors are taking place. So my view is that, is it going to shift things? It'll shift some cross-border flows, but change the countries that are net short oil and have to hike is not going to change the infrastructure demand, because all the AI companies are primarily focused in the United States. And obviously we have some China dynamics in there, but we won't cover those right now. All right, let's see. Other questions here. Do you see a world where other countries use stable coins as payments so there wouldn't be the need to hedge or swap out of the dollar? No, that's not really how it works. If you use stable coins, what are those pegged to? The dollar. So you're just using a dollar in a different wrapper. You're not, you still have to hedge that, which is why if you look at stable coins, and if you look at like dollar stable coins versus yen stable coins, they move in lockstep with the exchange rate, because go figure, you know, it's the same thing. So it doesn't, stable coins do not change anything really. Stable coins just add more transparency and liquidity in the system, backed by various forms of collateral. And they do not change asset liability relationships on a fundamental basis. That's what I would say about that. They actually just add credit risk. However, because, you know, if you have a stable coin, you're functionally have an asset and it's someone else's liability. And that someone else is not the US government. It is whoever the stablecoin issuer is. That's fine if you're fine with that, but you're taking the risk of the stablecoin issuer and dollars. So that's why you actually have a risk premium. That's why you can get more in stablecoins, because you're actually taking some credit risk. It's not just, oh, I get to hold dollars, because technically you're not holding dollars. All right, another question here. James, why don't you touch on this one? How do you handle adding to positions if, like right now, dips aren't happening, just not adding, or do you have another strategy? How would you think about that kind of dynamic?
Yeah, so this is something I've been talking about with other people too, right? A video I want to make pretty soon is going to be like some of the most unique insights from my trading career that like I think are super important that other people don't ever talk about. And one of the things I think is most important is second and third order effects and compounding of mistakes, right? Like again, we've talked about this before, but like one of the worst things you could do in a melt up is like, you know, you'd call it FOMO and chasing, right? But like day after day after day after day that you are not allocated to things that are going up and up and up and up. You might the first day think, I'm going to be patient here. I'm going to be waiting for a pullback. I'm going to be looking for the names I want. I have price targets that I will get in, or whatever it may be, because you didn't want to buy the highs. Then the next day, maybe you're a little less patient, but you're still sidelined. Then the next day, and ultimately the market is going to wear you down and force you into buying a high or putting money into some like underperforming beta to try and play catch up that 4 or 5 days ago you never would have done. And I think that mistake, I consider that a mistake, will then put you in a situation where you'll likely be buying at the absolute worst time. And then you will be down, which will then lead you to chase more, which will then lead to second order, third order mistakes that can be catastrophic. So in this specific time period where we've seen all of these things go, right? You're probably asking this question because you're probably looking at Intel, you're probably looking at Micron, you're probably looking at A-Lab or whatever the flavor of the day is. And what you should really be doing in my eyes is like developing watch lists, learning about the AI 5-layer cake, understanding which class you feel most comfortable with, you have the most conviction in, planning out kind of what you want to do, allocating certain portions of it. Maybe you do need exposure right now to eliminate that big risk, but maybe it's tiny, just so you could at least feel like you're participating, right? Sometimes I think even just having a little tiny position can satisfy the itch that will allow you to clear some mental capacity to then be patient for your bigger bets. And then like I look at things like this, right? So like the VIX and the VVIX, right? So we're kind of in the middle of these ranges here. The VIX is in the white, or sorry, the VVIX is in the white. And you could kind of say to yourself, like, well, I don't know if that's at any sort of extreme. So you could still see like rotational stuff. Same with the VIX, which is in the kind of dull pink there, right? We're at the lower end of the range. So I as a trader am thinking to myself, like, look, James, I know you've made a lot of mistakes in the past when you're in position, when you're in scenarios like this where you really feel the urge to get into something because it's been a lockout trade. Pullbacks are just getting eaten up. I'm not really getting the entries that I want. And I look at this and I'm like, well, to me, the asymmetry of risk here is maybe a little bit to the upside. And you're seeing actually VIX up 5% today, VVIX up. Like, I wouldn't be surprised to see a Tuesday pullback, shakeout that means nothing in the grand scheme of what we've been talking about, but might allow me to start positioning in a way that I want. And if I don't get it, I have to be okay with that. And again, maybe it's just a tiny position or something. That's how I think through these things. And I would just say, you know, when you say right now dips aren't happening, that's just like, I'm reading that as a recipe for disaster. So I think you need to start thinking through personally how you can maneuver through this. Because again, if you pull the trigger somewhere at the wrong time, it can lead to you pulling the trigger on your five subsequent decisions at the wrong time. So before you do anything, I would really step back and think about how you want to approach this, what your portfolio looks like, what your time horizons are, how much risk you can handle, all the things I talk about on my channel all the time. Then maybe reapproach it and be like, maybe I do need a position, or maybe I don't. Hopefully that made sense.
Yeah, I think that's really good. How do you think about this kind of question as well?
Yeah, that's another one where it's like, it depends, right? Sometimes the stars align and I can put on a huge position, and sometimes it's just not the right time, but I want exposure, so I'll dip my toe. Qualcomm's a good example, right? Like where we started the show with Qualcomm is like, I got on some of a position. Was it what I wanted? No. But then the trade kind of took off and it didn't allow me to do what I want. And if I was stubborn about that, I probably would have top blasted some more and it would have worked out. However, I think that would have been, going back to the luck thing, that would have been lucky. And then down the road, I would have said, well, I did it once before and it worked, so I should do it again. And then that time I might get blasted in the face with bigger size, and it could be actually a mistake then that started now, right? So I'm always trying to tie together like my past, my current, and my future, how all my decisions are kind of synthesizing together, and whether or not I'm actually acting from a moment of presence, if that makes sense. So it depends for me, but I'm not afraid if all the stars align and I really feel like it's a true clean idea to size up a lot aggressively when it doesn't necessarily make sense to everybody. But Absolutely. I'm also willing to step back and not feel like I need to have so much size when it does make so much sense.
Yeah, 100%. I think that's really good. On these final questions, and again, everyone go to the channel here, James Rosenthal on YouTube. If you guys aren't already there following all his videos, I would encourage you to. I mean, these are just, half of it is getting the macro side right, and the other half is being able to have the individual capacity to respond correctly with the information that you have. Both are necessary components, and that's why we're both on here sharing the different specialties we have in each of those components, because James and I have been just working together to help each other on those two sides of the coin for years, and it's been really beneficial for both of us because we both added a lot of value to each other. And the entire goal is that all this stuff that we're doing, you guys can be able to follow along on everything that we're doing. For James on his side, you can go to his channel, and then also for all of the stuff that I'm doing on my side, you can there's another question here that is asking about Warsh and, any other commodity views and things like that, again, you want to go through all of the archive, right? If you're like, hey, I don't really have the context right now, I'm trying to really catch up. What you need to do is set aside a block of time of 3 or 4 hours. And I know that sounds like a lot, but don't have high expectations of understanding the context if you're only going to put in, a 10-minute, portion of time, or expect to kind of scroll through social media, click in and out of markets, and expect to have exceptional returns. It's just not going to happen, and you shouldn't expect it. On all the views that I have, especially on Warsh, I think he's going to be one of the biggest game changers. I did an entire live stream on him, right? So you can go through this entire live stream. Myself and James went through how should you think about inflation as the Fed's choice, the regime change, how interest rates are a tool, how the balance sheet reduction can be coordinated with the Treasury, every single thing. It's all laid out right here. And again, all of the different sections are laid out here at the top of the website. So, and then you have obviously all of the educational primers on the main page right here as well. So you can go through all of these, all the free educational primers right here. What I would encourage you to do is just keep stacking edges as you are putting in the work. And so I would challenge and encourage you, be intentional, expect returns that are comparable to the level of inputs and difficulty and sacrifice that you are making. And if you begin to expect it beyond that, that's when you're going to reach and become greedy and have a situation that just totally takes you out at the knees. And then you're going to be in a worse situation where it's going to be even harder. And the entire goal is to give you all the tools so that you can make the best decision. No one can make you successful except for you, right? And so I even tell people, that'll message me and say, hey, man, I really appreciate everything that you've done, all the work that you put out. I always say, hey, that's you. Like, you're the one that actually put in the time to be able to learn everything, be successful, and get a job at a hedge fund, manage your own money, be able to make decisions on behalf of clients, whatever it might be, wherever your role is in the financial industry or as a trader or whatever it might be. So that's the entire goal of all of these sessions, which we're doing every single day. And, I'll lay out all the slide deck, everything else. James, what would you kind of encourage people with on that kind of, vein of thinking as well?
Yeah, I think you just need to spend money to make money. Like, get over this hump. Me and you spend a lot of money and time on other people, on other ideas. We're intentional with reaching out. We have a call in an hour and a half to try and better our craft here, right? And we'll probably spend some money on that to do that call. I think everybody here who is a free subscriber to Global Flows, pay the money, right? Commit a year to becoming the version of the trader and investor you want to be, right? If you feel like you're a dialed macro person and thinker and original thought or whatever, but you struggle with execution and mindset and P&L affecting you too much or whatever, come join my Discord, right? Come do that. Come talk to me, jump on the calls I do, whatever. If you feel like you're really solid at that, but you really struggle in the macro field and you don't understand how the Trinity that we've been discussing for 2 hours today works, then dive into Capital Flows research and spend a year and do it. Because the amount, and this isn't even just our two things. I spent $15K on an NFT to gain access to a group of people I wanted to be able to talk to every day. And that has paid off way, way more than the funny pixelated picture, right? I understood I was looking past the picture, right? But I'm willing to spend money to make money, and it's paying off on the back end. So if you have that scarce mindset of you're not willing to really invest in yourself, you're going to break rules because you feel deep down, you feel like you haven't actually put in the work. You haven't invested in yourself. So you don't deserve the success. And I actually think that will show through in your investments personally. So take it seriously.
I think it's great. I think It just goes back to that idea that we talked about is whatever you're doing right now, you should take it way more seriously than you are.
Yeah.
Right?
Who was
Because-
that? That was the TBPN, right?
Yeah,
What was
those
that
guys.
example?
Some guy like talked to them. We talked about this offline a bunch, where he was just like, "Hey, what you guys are doing right now, it's really cool. You guys need to take it 100 times more seriously than you are right now." Because he was like, "You guys are really good. You have the potential. You need to don't." Because like a lot of people, especially when you're just growing, you don't take things seriously because you don't have any stakes in the game. No one's talking to you. No one's watching you. No one's looking to you. You don't have a ton of money at stake. And so you don't take it seriously. But if you take things seriously in the small things, then I think about the biblical concept all the time. That's where I really come from, is if you're faithful in little, God will give you more, so you're faithful with much. And that is what I think about all the time, because if you can't be excellent in the small decisions in your life with how you're just executing through your day and the little things, you're never going to be given more. Don't expect to be able to come in and just bench 300 out of nowhere when you can't even, just show up at the gym. So I think that's just
I don't know, buddy. I don't know about that one.
Well, it's true. It's true. It's hard for me to
Right.
be able to squat it because the bar is always so far above me.
You
There's
guys ever seen a guy lay down on a bench and not be able to reach up to the bar? It's crazy.
There's a massive height differential between myself and James.
Yeah, rate differentials are crazy.
There's like a 3-foot height difference.
Hey, but you can outrun me any day of the week. You got
That's
that.
true. It's true. I've what is it? You were just tall enough to get the perspective that you needed, and I was just short enough to have a small man syndrome, so that I can't. That I have a chip on my shoulder.
That's right. You're like Achilles, man. You have a big role. A big role.
Great stuff. All right, everyone. Everything will be laid out on the website. You guys know where it is. We will be doing this again tomorrow morning, 8:30 a.m. Mountain Standard Time. If you guys have any questions, we'll continue to go over them as well. And then I'll be laying out a report breaking down things further on the website. So all my stuff, you guys know where it is. Go through all of James's stuff. I'd encourage people to go join his Discord and all the things that he's doing. And with that, we will catch you guys tomorrow morning.
See you later.